Welcome to Mutilating News, a deeper dive into global market trends as of early November 2024. U.S. economic resilience. The bond market. The U.S. economy remains robust, with GDP growth of 0.8% in Q3 and significant strength in the labor market. This has fostered optimism, but also created a paradox where bond yields have increased sharply despite recent rate cuts. The 10-year and 2-year Treasury yields have risen by about 50 basis points, signaling heightened inflation expectations and a reevaluation of the Federal Reserve's monetary stance. This uptick in yields in a steepening yield curve reflect expectations that inflation could persist, leading to a potentially slower pace of rate cuts going forward. Tech sector and valuation concerns. Equity markets, especially the S&P 500, have been largely driven by gains in the technology sector, with high valuations for Magnificent Seven companies leading tech firms. While these companies have shown strong performance, the overall forward 12-month price-to-earnings P/E ratio for the S&P 500 remains elevated, surpassing its 5- and 10-year averages. Investors are cautious about whether earnings can continue to support such high valuations, particularly if economic data falters or interest rates unexpectedly rise. Gold's record high performance. Gold has soared to a record high of $2,789 per ounce, largely due to three factors. 1. The Federal Reserve's rate cuts, which boost non-yielding assets like gold. 2. Heightened geopolitical risks, particularly conflicts in the Middle East and Ukraine. And 3. Continued demand from central banks and investors. China's economic stimulus and global impact. China's stimulus efforts, aimed at reviving growth and supporting its struggling real estate sector, are expected to lift global demand, particularly for commodities and industrial materials. European markets and ECB influence. Europe. The European Central Bank's easing policies are providing support for high-yield bonds, which have shown relative resilience. Geopolitical and political factors. The U.S. presidential election has introduced additional fiscal concerns, with both candidates proposing policies that could expand the national debt. If the election results in increased government spending, bond yields may face further upward pressure due to higher issuance. Trade policies and potential tariffs are also on the radar, with implications for inflation and supply chains depending on the election outcome. These factors add a layer of uncertainty that could influence markets well into 2025. In summary, global markets are experiencing a complex mix of economic resilience, elevated asset valuations, and geopolitical tensions. The evolving stance of central banks, particularly the Fed and ECB, will play a key role in shaping market directions, as will China's stimulus impact and the U.S. political landscape. For more information, contact us at www.mutiillwin.com. info@mutiillwin.com.